Friday data on the US labor market may seem disappointing at first, but market participants carefully evaluated the issued reports. On the one hand, the number of new jobs was only 199,000. At the same time, a surprising drop in the unemployment rate to 3.9% encouraged the markets. Besides, the average hourly earnings have also increased to 4.7%. This data intensified market expectations that the Fed may raise the rate sooner than planned. Still, traders were taking profit on long positions on the US dollar that were opened during the previous trading week. The US dollar index, which measures its value against the basket of 6 major currencies, dropped below the mark of 96, with a prospect of renewed growth. Recent FOMC minutes stated that strong labor data could be the reason for a faster rate hike and a reduction in the regulator's balance sheet in order to curb rising inflation. All these factors will contribute to the growth of the US dollar. The euro versus the dollar pair is now trading near a 17-month low, heading towards the level of 1.1200. Notably, the most popular currency pair on forex has been holding in the sideways channel since November 26. Market participants hoped that the jobs data on Friday could push the quotes out of the current range, but this did not happen. The pair is likely to decline further. The European Central Bank is slower than other regulators when it comes to tightening monetary policy. Besides, the Eurozone is still concerned about a slowdown in the economic recovery amid high inflation and coronavirus resurgence. Meanwhile, the British currency is showing a different dynamic. The pound versus the dollar pair closed last week with a gain of 0.5%, having approached a 2-month high at the level of 1.36. Investors expect the Bank of England to maintain its hawkish stance and raise the key rate during its January meeting. What's more, markets are encouraged by the decision of the UK government not to tighten restrictive measures, despite the spread of the new strain in the region. At the end of the last week, Bitcoin tested the support level of $41,000 per token. The release of the FOMC minutes put pressure on the digital currency, as well as civil unrest in Kazakhstan. For your reference, Kazakhstan is currently the second largest center for mining Bitcoin. Massive anti-government protests forced the authorities to impose a curfew and cut off the internet in the country. As for the oil market, it added 4.5% last week. BRENT crude advanced to $83 per barrel. Again, geopolitical factors supported crude prices amid social unrest in Kazakhstan. In addition to crypto mining, Kazakhstan is one of the largest oil producers in the world. Besides, disruptions to crude supply in Libya also contributed to the rise in oil prices. At the same time, oil reserves in the US are reported to have declined. Meanwhile, the OPEC Plus members confirmed their intention to stick to their plan of a gradual production increase. Speaking of gold, traders' fears over the Omicron strain and its impact on the global economy seem to be vanishing now, so the yellow metal is slowly losing its ground, while the risk appetite grows. Moreover, expectations of a rate hike by the Fed also weigh on the price of gold. Although it's traditionally viewed as a hedge against inflation, high interest rates raise the cost of keeping gold as an investment. And you've watched the combined financial review on Insta TV with me, Anna Kasatkina. See you back soon.